I made my first million when I was 45 years old, a slow, grinding process that took 2 decades. I made my first billion when I was 78. You want to know the difference between those two journeys? It's not what you think. I didn't get smarter. I didn't find some secret. I just stopped doing profoundly stupid things. Everybody is looking for the magic bullet, the one stock that will change their life, the perfect market timing, the secret algorithm. Let me tell you something. There is no secret. There is no magic formula for getting rich. There is only a checklist for staying poor, a list of surefire ways to guarantee you end up with nothing. If you can just avoid the items on that list, you win the game. It's that simple. I have sat in boardrooms and watched men with IQs of 160 make decisions a child would know are idiotic. I've seen them destroy themselves, destroy their families, destroy fortunes that took generations to build. Why? Because they committed one of these fundamental sins. Today, I'm giving you that list. The 9 financial sins that will cost you your future. They will cost you decades of your life and millions of dollars. If you're guilty of even 4 of these, you're already so far behind you may never catch up, so listen carefully. Sin number 1. You are chasing complexity because you think it equals sophistication. This thinking is utterly backward, completely and totally wrong. You see a hedge fund using complex derivatives and algorithms, and you think, wow, they must be smart. I think, wow, they have 1,000 ways to blow up. I don't look for things I can't understand. My rule is simple. If I can't explain the business to a reasonably intelligent 10-year-old in 3 minutes or less, I don't buy it. I want a business with a moat so wide a fool could run it, because sooner or later, a fool will. Look at the great financial disasters, long-term capital management. You had 2 Nobel Prize-winning economists on the board, the smartest guys in the room. They built models so complex, so arcane, that no one truly understood the risk they were taking on, and it blew up the entire financial system. Look at the mortgage-backed securities of 2008. CDO squared, synthetic instruments. Complexity was a mask for fraud and stupidity. You spend 3 hours researching a $100 coffee machine to make sure it has the best features. But you'll throw $20,000 into a biotech company whose prospectus you can't even read because it sounds high-tech and sophisticated. It's insanity. Here's your rule, the inversion test. Before you invest, don't ask how could this succeed. Ask how could this fail. List every possible way it could go to zero. If that list is long and complicated, you run. Your homework. Go through your portfolio. Find the one investment you understand the least. The one you bought because it sounded smart. Sell it. Sell it tomorrow morning. I don't care if you take a small loss. Consider it a cheap tuition payment. Sin number 2. You are using debt as a tool to get rich faster. This one makes my blood boil. You're borrowing money to buy depreciating assets like cars. You're using margin to juice your stock market returns. You're treating your home like an ATM. Never, ever happen. Leverage is the only thing in the financial world that can take a man with a high IQ and a good business and turn him into a pauper overnight. It's the only way a smart person can go broke. My entire life, Berkshire's entire life, has been about avoiding leverage. We want to be in a position where we can survive any crisis, any market crash, any pandemic. We can't do that if we owe other people money. When the tide goes out, you find out who's been swimming naked. Leverage is what strips you bare. Think of the Hunt brothers trying to corner the silver market in 1980. They were billionaires. They used immense leverage to bid the price up, but when the market turned, the margin calls came. They were wiped out. Completely. not because they were wrong about silver in the long run, but because they couldn't survive the short-term volatility. Leverage gives you no room for error. You see your neighbor buy a bigger house with a bigger mortgage and you feel envious. You see a trader on social media bragging about 50x returns using leverage and you think you're missing out. You're not missing out on gains. You're missing out on guaranteed ruin. The simple test is this: the sleep at night test. Does any of your debt keep you awake? If a stock market crash of 50% would result in a margin call that wipes you out, you are playing Russian roulette with your family's future. Your homework is direct. Create a plan to become completely debt-free outside of a sensible mortgage. No car loans, no credit card debt, no personal loans. Cut up the cards. Live below your means. It's boring, and it's the only way. Sin number 3, you ignore the power of incentives. This is perhaps the most important and least understood sin. If you only learn one thing from me, learn this: show me the incentive, and I will show you the outcome. It is the single most powerful force in the universe. I have seen it time and time again. Seemingly good, moral people will do the most astonishingly unethical things when the incentives are structured improperly. Look at Wells Fargo. They wanted to grow, so they created an incentive system that rewarded employees for opening new accounts. A simple, logical goal. What was the outcome? Millions of fake accounts. A destroyed reputation. Billions in fines. The employees weren't evil. The incentive structure was. It drove them to fraud. Look at the investment banking world before 2008. Bankers were paid huge bonuses based on the volume of mortgages they packaged and sold, not the quality. So they packaged up garbage, sold it to pension funds, and collected their bonuses. The incentive was to create volume, not value. The result was a global meltdown. You are guilty of this in your own life. You wonder why your financial advisor puts you in high-fee mutual funds. Look at his incentives. He gets a commission. You wonder why your CEO is focused on short-term quarterly earnings instead of long-term value. Look at his incentives. His bonus is tied to the stock price this year, not in 10 years. The rule is this: the incentive audit. Before you enter into any financial agreement with an advisor, a partner, a company you invest in, you must ask one question: how do they get paid? Follow the money. If their incentive is not perfectly aligned with your long-term best interest, walk away. Your homework: make a list of the financial professionals in your life, your banker, your insurance agent, your advisor. Next to each name, write down exactly how they make money from you. If you don't know, your job is to find out. You will be shocked by what you uncover. Sin number 4. You think diversification is buying 100 different things. Wall Street has sold you a lie. They call it diversification. I call it diversification. They tell you to buy a little bit of everything so you're protected. That is a confession of ignorance. It's for people who have no idea what they're doing. It guarantees one thing and one thing only: mediocre results. You will get the market average minus fees. It's a path to comfortable poverty. I believe in the opposite. I believe in concentration. The way to get truly wealthy is to find a very few truly great businesses and then bet heavily on them when the odds are in your favor. All the great fortunes in history were built this way: Carnegie in steel, Rockefeller in oil, Ford in automobiles, Gates in software. They didn't own a little bit of everything. They owned a whole lot of one great thing that they understood better than anyone else on the planet. The historical evidence is clear. Look at the performance of the average mutual fund versus the S&P 500. Year after year, the vast majority underperform. Why? Because they are forced to own hundreds of stocks. the good, the bad, and the ugly. They are diversifying. They are closet index funds charging you active management fees. You think you're being safe by owning 200 stocks in your mutual fund. You're not being safe. You're just ensuring that your few brilliant ideas are drowned out by your many mediocre ones. It's like having a basketball team with Michael Jordan and then forcing him to pass the ball equally to 12 clumsy amateurs. It's a recipe for failure. The rule, the punch card test. Imagine you have a punch card with only 20 punches on it for your entire life. Each time you make an investment, you use one punch. You would become incredibly careful. You would wait for the absolute best opportunities, the no-brainers. You would do your research. You would only swing at the fat pitches. Your homework, look at your portfolio. If you have more than 15 individual stocks, you're doing it wrong. Your task is to identify your 5 best ideas, the companies you have the highest conviction in, and over the next year, develop a plan to consolidate your capital into those ideas. Sin number 5. You are operating outside your circle of competence. This flows directly from the last sin. The reason people diversify is because they don't have a circle of competence. They don't know what they know, and more importantly, they don't know what they don't know. The world is full of people who think they are experts in everything. They have an opinion on interest rates, on geopolitics, on the future of artificial intelligence, on the price of oil. They are confident, and they are almost always wrong. My approach is different. I have a very small circle of things I understand well: insurance, banking, consumer brands, simple, boring businesses. Outside of that circle, I have a big sign that says, "Here be dragons." I don't go there. I have no opinion. It's not my game. The dot-com bubble is the greatest case study in history. In 1999, everyone was an expert on internet stocks. People who couldn't tell you the difference between gross margin and net margin were betting their life savings on companies with no revenue and no business plan. They were operating so far outside their circle of competence, it was comical. We at Berkshire were called dinosaurs. We were told we didn't get it. We sat on the sidelines and watched the inferno. And when it was all over, we were the ones with the cash. You do this every day. You hear about a new cryptocurrency, and you feel you have to have an opinion. You have to get in. You don't understand the technology. You don't understand the valuation. You don't understand anything about it except that the price is going up. You are gambling, not investing. The rule, the explain it to me test. Before you invest a single dollar, you must be able to explain the business and why it's a good investment to someone who knows nothing about it. If you stumble, if you use jargon, if you can't make it simple, you don't understand it well enough. Your homework. Write down on a piece of paper the industries or businesses you genuinely understand. Not what's popular, but what you truly know. Maybe it's retail because you worked in it for 20 years. Maybe it's software because you're a programmer. That is your circle. Make a solemn vow to never, ever invest a dollar outside of it. Sin number 6, you are hopelessly impatient. The world wants you to be impatient. Your brokerage app sends you notifications every 5 minutes. The financial news network screams at you about the stocks moving right now. They have turned investing into a video game. This is the enemy of wealth. The single greatest advantage an individual investor has is a long time horizon, but you squander it. You are trading, not investing. You check your portfolio daily, hourly. You get excited by a 5% gain and terrified by a 5% loss. I have a different view. My favorite holding period is forever. We buy a business with the intention of never selling it. Wealth isn't built in days or months. It is built in decades. It is the product of one of the most powerful forces in the universe, compound interest. But compounding needs one fuel to work, time, and your impatience is starving it of that fuel. Look at the history of any great company: Coca-Cola, See's Candies, American Express. There were decades where the stock went nowhere. There were periods of terrifying 50% declines. The people who got rich were the ones who bought it and then went to the beach for 30 years. The people who lost money were the ones who tried to dance in and out of it. You are your own worst enemy. You sell your winners too early to lock in a small gain, and you hold on to your losers, praying they'll come back to even. This is driven by nothing but emotion and impatience. You are snatching defeat from the jaws of victory. The rule: the gardener's mindset. Think of yourself as a gardener, not a trader. You plant a seed, buy a great business. Then you patiently water it, give it sun, and let it grow. You don't pull it up every day to see if the roots are growing. You trust the process. Your homework: for the next 30 days, I forbid you from looking at your portfolio value. Delete the app from your phone. Block the websites. At the end of 30 days, you will realize the world did not end. You will have broken the addiction. Then do it for another 30. Sin number 7, you fail to invert. Normal people think forward. They ask, how can I achieve success? They make a list of things to do to get rich. The wise man thinks backward. He inverts the problem. He asks, what would guarantee I stay poor? And then he makes a list of all the things he must avoid. It is a far more powerful way to think. All I want to know is where I'm going to die, so I'll never go there. It's the same in finance. I want to know all the ways I could possibly go broke, so I can avoid them. All the sins on this list are a product of that inverted thinking. The entire 2008 financial crisis was a failure to invert. The banks asked, how can we make the most money from mortgages? The inverted question would have been, what could cause the entire mortgage system to collapse? The answer would have been obvious: lending to people who can't pay it back, packaging those loans, and leveraging the whole system to the hilt. Had they asked the inverted question, the crisis may have been avoided. You do this with your career. You ask, how can I get that promotion? You should be asking, what would guarantee I get fired? The answers are simple. Be unreliable, gossip, miss deadlines, produce sloppy work. Now you just have to avoid those things. You do it with your investments. You ask what stock will go up the most. You should be asking what kind of company is almost certain to go bankrupt. The answers: companies with huge debt, no competitive advantage, a history of losses, and crooked management. Now you have a simple filter to avoid disaster. The rule: always invert. Before making any major decision, financial or otherwise, stop and ask the opposite question. What do I want to avoid? What would guarantee failure here? This simple mental flip will save you from more trouble than any other model. Your homework: think of your biggest financial goal. Maybe it's retiring by 60. Now invert the problem. Write down a list of at least 10 things that would absolutely guarantee you have to work until you're 80. That is now your not-to-do list. It is more important than your to-do list. Sin number 8. You overpay for everything, especially quality. There's a saying on Wall Street: a wonderful company at a fair price is better than a fair company at a wonderful price. That's true, but people have taken it to an insane extreme. They believe that a wonderful company is a good buy at any price. This is a catastrophic error. Price is what you pay. Value is what you get. And paying too high a price for even the best business on earth can lead to a decade or more of dead money. The Nifty 50 bubble in the early 1,970 seconds is the perfect example. These were the One decision stocks, companies like Coca-Cola, IBM, Polaroid, the bluest of the blue chips. The thinking was you could buy them at any price and hold them forever. People were paying 50, 60, 80 times earnings for them. They were wonderful companies, but the prices were insane. What happened? The 1973 to 74 bear market hit, and these stocks collapsed. Some of them fell 80% or more. It took more than a decade for many investors to just get back to even. They were right about the quality of the company, but they were so wrong on the price that it destroyed their returns for a generation. You are doing this right now. You see a fantastic, innovative company growing at 50% a year. You fall in love with the story. You ignore the valuation. You pay a price that assumes a decade of perfect execution. But life is never perfect. One bad quarter, one new competitor, and that high-flying stock can come crashing down to earth. The rule, margin of safety. This is the cornerstone of all intelligent investing. You must buy a business for significantly less than your conservative estimate of its intrinsic value. This discount, this margin of safety, is what protects you from bad luck, errors in judgment, and the vicissitudes of the market. Your homework: pick your favorite stock, the one you love the most. Now do an honest valuation. Be conservative. What is it really worth? Now compare that to the current market price. If there is no significant discount, if you don't have a margin of safety, you have a problem. You're paying for perfection, and perfection never lasts. Sin number 9. You are a slave to your own psychology. This is the final, and perhaps most difficult, sin to overcome. All the other sins, chasing complexity, using leverage, impatience, they are all just symptoms of this one root cause. You are not a rational machine. You are a bundle of cognitive biases that are hardwired into your brain to make you a terrible investor. Loss aversion makes you feel the pain of a loss twice as much as the pleasure of a gain. So you sell winners and hold losers. Herding instinct makes you want to buy when everyone else is buying at the top and sell when everyone else is selling at the bottom. Overconfidence bias makes you think you're smarter than you are, leading you to trade too much and take foolish risks. I have spent a lifetime studying these biases. I have seen them fell the most brilliant of men. The market does not care about your IQ. It is a machine for transferring wealth from the psychologically weak to the psychologically strong. Think of Isaac Newton, arguably one of the most intelligent human beings who ever lived. He lost a fortune in the South Sea bubble. He famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." He understood the physics, but he didn't understand his own psychology. He got caught up in the mania, just like everyone else. If it can happen to him, it can most certainly happen to you. You think you are immune. You think you are a rational, logical investor. You are not. You are an ape with a brokerage account. The sooner you accept this, the sooner you can build systems to protect yourself from your worst enemy, you. The rule, the pre-mortem. Before you make an investment, assume it has failed catastrophically a year from now. Write a detailed story of exactly what went wrong. Did you get caught in a market panic? Did you overestimate the company's moat? Did you fall in love with the story and ignore the numbers? This exercise forces you to confront your own biases before you commit capital. Your homework: read a book on behavioral psychology, not an investing book, a book about how your own mind works against you. Understand the enemy within. It is the only path to true wisdom. So there you have it. 9 paths to guaranteed financial ruin. Avoid complexity. Avoid debt. Understand incentives. Concentrate your bets. Stay in your circle. Be patient. Invert. Demand a margin of safety. and master your own psychology. It's not exciting. It's not fast. You won't get rich in 5 years doing this. But in 30 or 40 years, you will be wealthier than 99% of the people you know. You will be the one who owns the assets when everyone else is forced to sell. You will be the one who sleeps soundly during a market crash. If you've watched this far, you're one of the serious ones. Most people clicked away after the first two sins. They're already back to searching for the top 5 crypto coins to buy now. They are doomed to repeat the mistakes of history. But you're still here. That means you might just have what it takes. This channel isn't about hype. It isn't about stock tips or market predictions. It's about enduring, timeless principles for avoiding stupidity. Subscribe if you want more of the hard truth. Now I'm leaving. Go do the boring things that will eventually make you rich.